Welcome to another episode of the You Can Only Be You podcast. I am your host, Ucoby. This week, we're talking about portfolio allocation. Now, before I start, I do want to say a disclaimer. This is just my personal opinion. Everyone out there, before buying or doing anything with your money, I highly encourage you to do your own research and dive deep into what you want. There's different topics, different research, different data points you need to take into consideration when spending your money. Once again, it's just my opinion. Now, allocation. Allocation is how are you spreading out your risk, how are you using your money and spreading it in different investment forms and different vehicles. First and foremost, cash is king. Cash is king. We always want to have cash in our allocation because that's a nest egg. If things go wrong, if the stock market crash, if someone dies, we need to be able to go get this cash, boom, life-saving event. In apocalypse, we need to be able to have cash or gold, whatever, cash in your allocation. Now, I will say there are formulas out there that provide a template for allocation. For instance, one of the formulas that I know of is 100 minus your age equal your allocation into individual stocks or companies, right? That manages the risk. So let's say a 30-year-old, 100 minus 30, that means 70% of his portfolio should be invested into individual stocks. That's just a rule of thumb. Some people say 110 minus your age. I like to go off based on 100. So 100 minus 30, 70% should be put up into individual companies, not indexes. Now, when we start with cash, a lot of people will say 5 to 15%. Let's go in the middle of the road. Let's say 10%. 10% of all of your portfolio should just be consistent in cash. So that means in the bank. Let's say you have $100,000, 10%, $10,000 should be easily accessible to go to and get cash. Now, indexing investing, that's when you put your money into an index that mirrors the S&P 500. The S&P is an index that a lot of companies gauge and use as a benchmark. Benchmarks is something that they use to calculate will they be above or average out right at this benchmark. Now, the S&P is a benchmark, but you can also invest in an index that mirrors it. So they're going to have specific allocations with blue chip companies, small cap companies, different things involved. Now, indexing investing is a passive approach, meaning you don't want to know about this company. You don't want to do too many research. You want to just be able to put your money somewhere and guarantee return. Now, historically, I think in the last, 70 years, it has brought back anywhere between 7 and 12%. Last year, it did 15%. So let's say you had that 100,000 invested in the S&P index, it would have given you 15%. 15% is a great return on your money. I'm just saying that's a great return. The allocation, depending on your age, I will always suggest 30% should be in indexing. So if we have 10% cash, 30% in indexing, that's 40% of our portfolio right then and there, right? 30%, we're able to see that and hold long term. Now, another 15 to 20%, depending on your age, should be put into blue chip stocks, individual. So blue chip stocks would be anything that has a market value of 50 billion or more. Blue chips, the ones that are gonna last, that's been in it for the long haul. We talking Walmart, McDonald's, Apple, Microsoft, Bank of America, Coca-Cola, things of that nature. Blue chip companies that are known and have a brand that can spread out and that's going to be around for a while. They can also be dividend yielding companies as well. Walmart, I mean, that's the juggernaut of grocery stores, one-stop shops. So those are where your allocation should be when it comes to blue chip. I would say, like I said, 20%. Me personally, 15 to 20%. So now that we have 30% in indexing, 20% in blue chip, that's 50% with 10% in cash. That leaves 40%. Now, depending on your situation, I always say we should have another 30%, and your 30% should be put up into growth. Growth stocks, things that are being disruptive to the market. For instance, Tesla is a growth stock. Now, growth stocks meaning they can have a potential for high return, potential for taking off, going to the moon. But also they have a lot of validity and a lot of risk. At any point, they can drop 20 to 30% below. Now, we want to put 30% of our allocation into this sector. for the long haul. Now, short-term returns, a lot of growth can have a lot of quick returns, but when I say long haul, we're talking you shouldn't need this money for another 5 to 10 years. Personally, once again, do your research. One of the growth stocks that I love is Square. Do your research on that. That's my baby. Everyone should have a baby. If you don't know where to start, just Google growth stocks. Also, a growth ETF like ARK, ARKK. That's one that is disruptive to the industry as well. So now we have 30% in growth, 30% in blue chip, 30% in index and 20% in blue chip, 10% in cash. That leaves us with another 10% in my favorite, real estate. The undefeated juggernaut of it all, real estate. Usually has the best returns. Real estate usually beats the market depending on the market of the real estate. Now, a lot of people say, well, I can't afford to go out and buy another property. Most people can't. So we're going to talk REITs, Real Estate Investment Trusts. Now, these allow you to invest into real estate, mostly commercial, and diversify the portfolio. Once again, you want to have diversification throughout your allocation. So when I say diversification, you want to have indexes, high growth, blue chip, as well as real estate, so everything can balance out. And also with your different sectors. Let's say you have a high growth in energy. You have high growth in technology. You have high growth in, let's say, communications, things like that. There's different sectors that you want to allocate within that allocation. I mean, you want to diversify within that allocation. So real estate is undefeated because you can diversify with commercial property and residential, but also you can also diversify with mature homes, senior living, communities, different things like that. Now, as crowd equity funding that a lot of people don't know about. Crowd equity funding allows you to get in on the ground level of a company before it goes public. This is all part of doing your research and diversifying that allocation. I believe real estate is always undefeated because, once again, it's hard cash. Hard cash meaning this is something that own hard power. Land, it's a physical asset, and it's going to appreciate over time with proper maintenance, of course. Now, once again, allocation. Rule of thumb, use 100 minus your age to give you a percentage of how you should be taking care of risk with your allocation. So 100 minus 30 for a 30-year-old, 70% should be put into individual stocks, with 30% being indexed. Now, once again, do your research. Within that 70%, how are we going to spread it out? Now, that's of your stock and investing portfolio. Once again, with that formula, that's investing in stock portfolio. That's 100 minus your age, let's say 30. That 70% should be invested into the market, with another 30% being allocated, whether it's cash, bonds, things like that. But once again, do your own research. Allocation matters. How are you going to leverage that with your age? The risk matters, so on and so forth. But once again, I thank you for tuning in. If you all have any questions, please reach out. I love to talk about it. You can only be you.
You can only be you, baby.